Hey folks, Andrew Packer here. Welcome to another edition of Trading Tips. So today I want to talk about one of the more interesting chart patterns. This one is actually the one that a lot of people like to have to sort of brag about, for having the bragging rights, or saying, oh yeah, this stock was running up and I went short right before it went down, or this stock was going down and down and down and then I bought it, or I did an options trade and it went the other way and I made a ton of money. So what kind of trades are these? These are what's known as reversals on the chart patterns. It simply means that if a stock's been going up, it now starts to go down, and if it's been going down, it now starts to go up. And there are a series of common chart patterns that you can look at to try and gauge when this reversal is about to happen so that you can plan your investments accordingly. Now, let's start with one of the most famous patterns of all. It's called the head and shoulders pattern. Not just, a shampoo anymore, but it's something that technical analysts rely on a lot. And it essentially looks like this. I drew this kind of in the intro video, but it's the idea that a stock is making a high, it pulls back, but then it makes a new higher high, pulls back again, but then it suddenly, the next time it rallies, it just doesn't quite get back to where it was before. And this is kind of the starting point, and usually after that, it starts to go down from there. And when you look at a lot of chart patterns in textbooks, or if you go online just to say, hey, what are some common chart patterns? They really just kind of show you this reversal part. But remember, before this happens, this guy's been going up like gangbusters until then. So this is a very common pattern, the head and shoulders. It's very recognizable. But there are many other patterns that can also indicate that things aren't quite going to work out the way you're expecting them to, and things are about to change. The next one I want to look at is just a very simple one. It's called a double top. It's the idea that you go and make a new high, you pull back a bit, you make another high, and then you pull back a bit, and then things start to go down again. It's not quite the same as the head and shoulders, where you have the very obvious lower high before a much larger decline, but it's a very common pattern to see in the market when there's a reversal at play. And of course, another variation of this is what's called the triple. It's the double, but with an extra one. And the idea is you make a high, you pull back, you get back to about the same high, but you don't make a new high, you pull back, and then a third time, you kind of get back to that old high, but not quite, and then it pulls back. And if you're not making new highs at some point in the market, investors and traders are going to say, okay, this is a dead trend. They're going to start taking their money out, and that's why you see declines further with these types of patterns. Now remember, we're talking about reversals, and these are common patterns for going from long to short, as something that's gone up now starts to go down. But the opposite is true for all of these as well. When a position is just getting pounded in a bear market, and it's making these lows, and it makes a lower low, comes back a bit, and then it starts. This is sort of the inverse head and shoulders. It's exactly like the one on the upside where you go from bullish to bearish, only this is from bearish going down, and now you're going bullish. The idea is, of course, you're no longer making the new lows. Traders are now saying, okay, it's likely that this is going to start trending higher from here. We're not going to wait for the price to fall further. We're just going to start buying from here. And this is where you start to see some of the more interesting rallies off the lows. And of course, the similar trend can happen with double bottoms, or even with a triple bottom, where if it doesn't break lower, at some point traders are starting to think, okay, this is where the low is, I can buy in safely, and now it's likely to start rallying from here. Those are some of the basic reversal chart patterns, but there are a few advanced ones as well that I want to just cover very quickly. So besides those common patterns, you can also get some situations that are very interesting, like called a rising wedge, for example. That's when a stock's been going up and it pulls back and it goes up and it pulls back and it goes up and it pulls back. And each time the rallies and the pullbacks are narrower and narrower each time. Sort of like this wedge pattern. And then at some point, right around the time these two lines would intersect, that's usually where you see it start to break to the downside. And the notion behind that is pretty simple. You can basically see from the increasing severity of how quickly things pull back that traders are getting more nervous the higher it goes, and that at some point, all the money that's in the trade is going to be in the trade, and then more people are going to want out than are coming in, and that's when you start to get the reversal and the pullback on that particular pattern. And there's also an expanding wedge, which you see a little less often, where you have sort of these narrow peaks and valleys that start to widen out. That's a little less common with a reversal pattern, but it can indicate that there may be a reversal as well. But that covers the gambit of most of the major reversal patterns that you'll see. And you will see them play out in individual stocks. You will see them play out in sectors. You will see them play out across the entire market. You will see it play out really in any tradable asset, not just stocks. So if you're watching the price pattern, you can see essentially in the short term, when traders and sort of the more sophisticated money in these trades are starting to think, okay, it's time for me to get out. So by following these patterns and knowing how to position yourself accordingly, you can prepare for a reversal and profit. And you can do that going from long to short when things go from bullish to bearish, or making a profit going long when something is finishing up a bottoming pattern and looks like it's about to head higher. So that'll wrap things up for this week at Trading Tips. I'm Andrew Packer, wishing you good trading and good financial health.